Good day, everyone. So, the next topic for this chapter, the chapter 15, is the cost of ordinary equity share. So, ordinary equity share does not represent a contractual obligation to make specific payments, thus making it more difficult to measure its cost than the cost of bonds or preferred share. In business firm, it raised equity capital, and we have externally and internally. And externally, it is through sale of new shares, when internally, it is through retained earnings. So what is retained earnings? It represents the portion of accumulated after-tax profit that the firm has not distributed to its shareholders and therefore is reinvested in itself. So, the cost of existing ordinary share is the same as the cost of retained earnings. So, it is said that the new ordinary equity share and the retained earnings are similar but not equal. The new ordinary equity share is higher than retained earnings because of the flotation cost involved, but firm will use lower cost retained earnings before they issue new ordinary equity share. We have cost of equity, letter A. So in here, we have different kind of approaches. So first one is the CAPM approach. It is most widely used method for estimating the cost of ordinary equity. So here is the formula. CAPM estimate of cost of ordinary equity share is equal to risk-free rate plus risk premium that is equal to the risk premium on the average stock scaled or down to reflect the particular stock's risk as measured by beta coefficient. So, this is the symbol of beta coefficient. So, let's proceed to the illustrative case or example. The calculation of cost of equities using the CAPM approach. So, assume that in today's market, risk-free rate is equal to 5.6%. The market risk premium is 5.0% and the zeta beta is 1.48, and using the CAPM approach, zeta cost of equity is to be 13.0%. So this is the solution. So cost of equity shares is equal to 5.6. The 5.6 is the free rate, and we will add this to the risk premium, which is the 5.0%, and multiply to zeta beta, which is 1.48%, and the result is 13.0%. So let's proceed to another example, the illustrative case 15.4, the calculation of cost of equity. So ABC Company ordinary equity share sell for 32.75 per share. ABC expects to set their next annual dividend at 1.54 pesos per share. If ABC expects future dividend to grow by 6% per share indefinitely, the current risk-free rate is 3%. The expected return on the market is 9% and the stock has beta or zeta's beta of 1.3. What should the firm cost of equity be? So, the solution, the cost of equity is equal to 0.03, which is the risk-free rate plus 0.09, the risk premium, and we will multiply it to the zetas beta 1.3 is equal to 0.1080, or we will convert it to the percentage, and the result is 10.80%. So, it is said that this approach is also used to measure the cost of retained earnings. So, the second approach is bond yield plus risk premium approach. In this situation, such as closely held companies where reliable input for CAPM approach are not available, so analysts often use a somewhat subjective procedure to estimate the cost of equity. So here is the formula. Cost of equity is equal to base rate plus risk premium. So that is the formula to estimate the cost of equity. So this is the illustrative example for this approach. So Prime Pipe Company long-term bond rate is 9.5%. The firm management estimate that its cost of equity should require a 3% point risk premium above cost of its own bond. Using the generalized risk premium approach, the cost of ordinary equity would be 12.5%, and this is found by substituting 0.095 and 0.03. So the solution is, so here is the formula. Cost of equity is equal to base rate of long-term bond, which is the 0.095, and risk premium is 0.03, and the sum is 0.1250, and when we convert it to the percentage, it would be 12.50%. So, let's proceed to the third approach, which is the dividend yield plus growth rate approach. So, generally, both the price and the expected rate of return on an ordinary equity share depends ultimately on the share expected cash flows. So, for business firms that expect to remain in business indefinitely, the cash flow are the dividends. So, the required rate of return on ordinary equity, which for marginal investor is also equal to the expected rate of return. The equation could use follow. So, KS, meaning the cost of required rate of return of ordinary equity, is equal to the dividend expected over current stock price, and we will add this to expected dividend growth rate. So let's proceed to discounted cash flow DFC approach. So the method of estimating the cost of equity, called the discounted cash flow or DCF method. DFC method. Consider not only the dividends yield, so DL is the dividend expected to be paid of at the year end, and the PO is the current stock price. So we will divide it, but also a capital gain, which is the symbol of G, for a total expected return of K. And in equilibrium, this expected return is also equal to the rate of return. So, this is the equation. So, it is said that it is not difficult to calculate the dividend yield But if stock price fluctuate, the yield shall vary from day to day, which lead to fluctuation in the discounted cash flow cost of equity. Also, it is not easy to determine proper growth rate. If part growth rate in earnings and dividends have been relatively stable, and if investors expect a continuation of past event, gain may be based on the firm's historic growth rate. So here is the illustrative case to determine the cost of equity under the DCF the DCF approach. So we have Zeta stock sells for 23.6 pesos. Its next expected dividends is 1.25 pesos, and analysts expect its growth rate 8.3%. Thus, Zeta expected and required rate of return, hence, its cost of retained earnings are estimated to be 13.7%. So here is the solution. 1.25%, which is the expected dividends, divide 23.06, which is the stock sales that Zeta sells. So, we will add this to 8.3%, which is the growth rate. So, here is the result. 5.4% plus 8.3% is equal to 13.7%. So, based on the DCF method, 13.7% is the minimum rate of return that should be earned on retained earnings to justify flowing earnings back into the business rather than paying them out to shareholders as dividends. Let's move on to earning price ratio method. It is a simplistic technique used to estimate the cost of ordinary equity. So, ito yung pinaka-simple na technique para ma-estimate ang cost of ordinary equity, which is based on the investment firm price earning ratio. It's easy to compute because it is based on the readily available information. So, yung mga information ay ready na kaya madali na itong i-compute. But there is a little economic logic to support the use of earning price ratio to measure the cost of ordinary equity. So, equation that shows earning price ratio is found by dividing the current earning per share divide current market price. So, here is the formula. So, we have here the illustrative case 15-7. So, it is the determination of cost of equity using the earning price ratio. So, Prime Pipe Company had earnings per share for the 5 years past year of 6.50 pesos, and the firm ordinary equity share is currently priced at 45 pesos. Using the price ratio method, the cost of retained earnings would be 14.44%. So this is found by substituting the current per share earnings and the current market price of ordinary equity share, which is the 6.50 and the 45 pesos. So, 6.50 divide 45 pesos, the result is 0.1444. Let's proceed to the cost of new ordinary equity share. So, the constant growth model for new ordinary equity share is generally used in measuring the cost of new ordinary equity share. So the equation is cost of new equity share is equal to dividend to be received during the year over net proceeds of new ordinary equity share issue. And we will add this to dividend growth rate. The flotation costs include both underpricing and an underwriting fee. So what is underpricing? So what is underpricing? It occurs when new ordinary equity share sell below the current market price of outstanding ordinary equity share in order to attract investor and to compensate for the dilution of ownership that will take place. So underwriting fee covers the cost marketing the new issue. So the constant growth model assumes that dividend grow perpetually at the constant annual rate. Gain. Estimate of gain are usually based on historical growth rate. If earnings and dividends growth rate have been stable in the past or analyst forecast. So here is the illustrative case 15-8, the computation of flotation adjusted cost of equity. Suppose that ABC Company ordinary share are selling for 32.75 per share. Company expect to set its next annual dividend at 1.54 pesos per share. All future dividends are expected to grow by 6% per year, indefinitely. In addition, let's also suppose that ABC faces a flotation cost of 20% on new equity issue. So, calculate the flotation adjusted cost of equity. So, here is the equation, and we will substitute the given and 1.54 pesos over 32.75 minus 6.55, and we will add this to the gain rate, growth rate, which is 0.6. So the result is 0.1188 or 11.88%. So let's proceed to the cost of retained earnings. It is similar to the cost of existing ordinary equity share. So yung iba nag-a-argue na ang retained earnings ay dapat cost free dahil ito yung nagre-represent sa money na left over pagkabayad ng dividends. So it is true that no direct costs are associated with retained earnings. This capital has still cost. Yun yung tinatawag nating opportunity cost. So the manager that works for the shareholders can even pay out earnings in the form of dividend or retained earnings for reinvestment in the business. After that, the manager should recognize that there is opportunity cost involved. So, laging involved yung opportunity cost when we talk about the cost of retained earnings. So, the firm need to earn at least as much as any earnings retained as the stockholder could earn an alternative investment of comparative risk. So, that would be all for this. Thank you.